You're watching Silver News Daily. Subscribe for more.
And that's bad. I don't think we're going to recover. I think it's going to be similar to the 30s, although in the 30s we weren't bankrupt. So this time when we don't recover, we go bankrupt. I think that's what we're looking at. We're looking at bankruptcy of the US, and that's the reason why I like gold and silver. Because if the government does default on its debt, then gold is going to go to the moon. And I think that is the reason why central banks are buying all the gold, because they basically see this, that the US is, they're not going to, let's just take it down to one data point. And that is the US bond market, and that's the Federal Reserve and the US Treasury being able to print their way out of this mess. Everybody says we got a printing press, we can print whatever we need. Germany had a printing press in the 20s. They couldn't print their way out. At a certain point, you can't print your way out. Once you go over the cliff, and that's kind of where you're at. You don't want to print when you have inflation. If you print when you have inflation, you get more inflation. It's pretty basic stuff, right? And then you get a feedback loop, a negative feedback loop, where people are dumping your debt because you're creating inflation. They know, what are you doing? And that's kind of where we're heading. We're heading into that negative feedback loop. And that's what I've been saying. I actually think we've already hit the point of no return, and people haven't noticed yet. I've noticed, but the average person hasn't noticed yet that we've already hit game over. We made a mistake when we thought that MMT was a viable economic theory. The Japanese basically invented MMT. We threw MMT on it. We basically defined what Japan did. So in 1989, Japan, they basically had a huge bubble in real estate and in stocks, a huge, massive bubble, and it basically popped. And we told them, well, you have to let these businesses go bankrupt. You have to let all this real estate go, get reset. And the Japanese decided, well, that's one choice, but why don't we just print money? Let's do that. Let's pretend that debt doesn't matter. And they invented MMT. And if you look at how much money they printed, but they got away with it because they didn't have the global reserve currency and they funded all internally. They'd never had inflation, so they just kept printing and printing and printing. And it got to the point where the Japanese central bank owned all of their 10-year bonds. They didn't even trade. The bonds didn't even trade. The central bank owned them all because they did yield curve control. Nobody would buy them at zero interest rate, so the bank had to buy them at zero. So they pegged their 10-year at zero rate. But basically what they did was they printed money like banshees. They just printed, and they got away with it. And so the US, when we had our problem in 2007, Hank Paulson said, okay, I need 750 billion. And they, just print it. And they're like, look, Japanese just printed trillions. We can print 700 billion. It's no big deal. But that's when we said debt doesn't matter.
The global economy is walking a razor's edge, and Don Durrett is sounding the alarm before it's too late. A catastrophic debt crisis is brewing, one that could send shockwaves through every market on the planet. The warning signs are everywhere: spiraling government deficits, skyrocketing interest costs, and central banks drowning in their own money printing schemes. But here's the real danger. When this debt bubble finally bursts, it won't just take down the stock market. It will ignite the most explosive bull run in gold and silver we've ever seen. We've seen echoes of this before. In 2008, trillions were printed to keep the system from imploding. In 2020, governments threw even more money at the problem. But this time, there's no way out. The world's financial leaders are running out of tricks, and the cracks are turning into full-blown fractures. When trust in the system evaporates, investors won't run to stocks, bonds, or even cash. They'll sprint toward hard assets, real money, gold and silver. Durrett's warning isn't just about a crash, it's about a reset, a total transformation of the financial system. And when it happens, those holding precious metals won't just be watching from the sidelines. They'll be watching history unfold as gold and silver erupt in a way most people aren't ready for. The only question is, are you? If you think this is just fear-mongering, stay with me, Because in the next few minutes, I'm going to show you exactly why this debt crisis isn't just inevitable. It's already happening. And once you see the facts, you'll understand why the coming bull run in gold and silver could be the biggest in modern history.
A lot of the TA analysts are bullish gold and silver and negative the stocks. And to me, that could happen, but since 2008, 2007, 8, anytime the stock market has dropped, gold has dropped and the miners have dropped every single time. So why is it going to be different this time? So I think the odds definitely favor gold and the miners going down if the stock market goes down. Thursday was a great example of that. They all went down together, and the miners got really hit hard. Now today, the miners were down, but then at the end of the day, the S&P started rallying, and gold rallied a little bit, and the miners, I think, actually turned green. So gold, miners, and the S&P all are kind of tied at the hip, and I think they will be tied at the hip on the way down. But where I diverge from a lot of people that are real negative on gold going down with the market and the miners going down with the market, where I diverge is I actually think that the reason gold is high right now is because of uncertainty. In other words, that's why it's high, not because of inflation, not because of expected inflation. It's uncertainty. And where the uncertainty is we don't know how international trade is going to unfold over the next 2-3 years. Because of the BRICS Plus, they want to kind of split away from the Swiss system. They want to kind of stop using the dollar. There's this huge uncertainty in the global arena, and also in the US economy. We haven't had a recession since 2009. We're overdue for one. If the US does go into recession, what kind of impact is that going to have? What reverberations is that going to have throughout the world? The US is 25% of global GDP. So if that goes down, that's going to impact everybody. They always say if the US gets a cold, everybody else gets pneumonia. So there's going to be reverberations. And so everybody's kind of front running that and buying gold because they're like, it's like we're going to have like this Bretton Woods, type of reset coming. They're calling it the Mar-a-Lago Accord. That's the reason why gold is high. So the uncertainty, in my opinion, is actually going to increase if the stock market goes down. So that means the demand for gold will actually go up. So from that perspective, I don't see gold crashing. Now, I do see it correcting, like it will fall down with the markets, but at a certain point, you'll have a decoupling where gold will bounce. The markets will be going down when this recession finally comes, and this correction.
The debt crisis isn't some distant threat. It's already in motion, and the numbers are staggering. Governments around the world are drowning in a sea of debt so massive that even the interest payments alone are becoming unpayable. The United States, over $34 trillion in debt and adding trillions more every year. Japan, a debt-to-GDP ratio that makes 2008 look like a warm-up. And Europe, struggling to hold itself together as economies buckle under the weight of endless borrowing. This isn't just another economic cycle. This is a slow-motion catastrophe, and Don Durrett knows exactly where it's heading. When debt grows faster than the economy itself, the system eventually collapses under its own weight. History has shown this time and time again. The Roman Empire debased its currency into oblivion. Weimar Germany's hyperinflation wiped out the middle class. Argentina, Venezuela, Zimbabwe, all destroyed by the same addiction to printing money and avoiding reality. And here's the terrifying part. Today's debt crisis is bigger than any of them. Governments aren't even pretending they'll pay this money back. Instead, they're using smoke and mirrors, rolling over debt, issuing new bonds to cover old ones, and praying inflation eats away at the real value. But that strategy has a fatal flaw. Once confidence cracks, once investors realize the money they're holding is backed by nothing but more promises, the entire system implodes. That's why Durrett isn't talking about a mild recession. He's talking about a full-blown crisis that forces central banks into desperate action. And when that moment arrives, gold and silver won't just rise. they'll surge as trust in fiat currency evaporates. But this is only the vecinas in the beginning. Because as this crisis deepens, central banks will be left with only one option: panic. And when that happens, the real chaos begins.
Having these severance checks, but he's basically firing them. He's asking them to retire early. He's asking them to quit. But bottom line is kind of firing 200,000 federal workers, and it might go even higher. Well, now they are going to get a severance check, but it's still going to put downward pressure on consumer spending. Those severance checks, uh, people are more apt to save those instead of go out and spend it all because they just lost their job, right? So that's going to have downward pressure on spending. But everywhere you look, I think you see slowdown in the economy. You slow these pressure. You don't see the green shoots. You don't see, what Trump can really do to kickstart these things. In other words, he's laying people off right now. He's not putting them to work. So it's kind of the opposite of what you need. And I don't see how he's going to put people to work quickly, if you will. So I think that one of the reasons he's got a budgetary problem. We have a $2 trillion deficit. He's talking about balancing the budget, in 1 to 2 years, which to me is kind of fantasy land, because he's not going to cut, 70% of the budget. He's not going to cut it all. For instance, interest payments, those aren't going to come down because the Fed isn't going to reduce interest dramatically this year unless we have a crash. Defense spending, I don't think will come down. Social Security and Medicare will not come down. Those four are the biggest part of the budget. So how do you balance a budget when you can't cut 70% of it, 70, 80% of it? So he has a budgetary problem. I think one of the reasons why he's pushing tariffs is he's trying to fix the budget. He's saying that it's unfair, but I don't think that's really his motivation here. I think his motivation is to raise money.
Central banks are trapped, and they know it. For years, they've played the same game: cut interest rates, print money, and pretend everything is under control. But the debt crisis has backed them into a corner, and now every move they make only makes the situation worse. Look at what's happening right now. Interest rates have skyrocketed as central banks desperately try to control inflation, but in doing so, they have set off a ticking time bomb. Higher rates mean governments, corporations, and consumers are all being crushed under the weight of their own debt. The US government alone is paying over $1 trillion a year just in interest, more than it spends on defense. It's unsustainable. But here's the trap. If central banks keep rates high, they risk a total financial collapse. If they cut rates to ease the pressure, inflation surges out of control. Either way, confidence in fiat currencies will shatter, and when that happens, investors will scramble for safety. That's exactly why central banks around the world are hoarding gold at record levels. They see what's coming. They know the only way out of this mess is through currency debasement, printing even more money to inflate away the debt. And when that happens, history tells us exactly what comes next. Gold and silver skyrocket. Every major currency crisis in history has followed the same pattern. When trust in paper money evaporates, precious metals become the only safe haven. Durrett sees it coming, and he's warning that the shift is already underway. But what happens when the stock market finally wakes up to this reality? That's when the illusion truly collapses.
The Atlanta Fed came out yesterday and said that their expectations for Q1 was negative 1.5%, which is a massive shift. They were at 3% at the beginning of the month. They were at 2.3% the last reading. So they went from 2.3 to negative 1.5. That's a huge move. And so right now, we don't know if we're going to get a positive or a negative number on Q1, but that slowing down in GDP, most of it was front running the tariffs. So most of it was imports. Pickup in imports is actually creates a deficit in overall deficit on exports, import exports, trade deficit, negative trade deficit. So, but we had a significant decline in consumer spending. And so we can't dismiss that. We can say, okay, this is a front running the tariffs and that's short lived. It's not going to last the whole year. But if you start getting negative, we get down there at 1% or less in GDP, if it doesn't pick up, it could have kind of an add-on effect where people start getting negative sentiment. Plus, it's kind of across the board. I mean, we're seeing negative weakness in economic numbers kind of across the board, which we've seen as slowing. We've always said that these high rates are going to have a lag effect. And we always thought, well, that lag effect is going to lead to a recession. It hasn't yet. Well, the lag effect is starting to catch up with us. For instance, housing and autos are definitely under pressure. People having to like use debt, spend money, like to go out to restaurants or retail, those are under pressure. So the consumer is definitely under pressure because of these high interest rates and inflation. And that hasn't gone away. So that's slowly putting pressure on this economy. And now Trump came into office and he's letting people.
The stock market is living in a fantasy, and Don Durrett is warning that reality is about to hit like a freight train. For years, Wall Street has been fueled by cheap money, endless debt, and blind optimism. But here's the problem. Those days are over. Rising interest rates have turned the stock market into a ticking time bomb. Companies that thrived on easy credit are suddenly struggling to survive. Zombie corporations, businesses that only exist because of low borrowing costs, are now facing bankruptcy as debt payments soar. The real estate sector is crumbling under the weight of higher mortgage rates. And tech stocks, which skyrocketed during the money printing bonanza, are now exposed to a brutal valuation reset. But here's what most people don't see. When the stock market crashes, it won't just be a normal correction. It will be the bursting of the everything bubble. Stocks, bonds, real estate, everything has been inflated by central bank intervention. And when the bubble pops, it will trigger a wave of panic, selling unlike anything we've seen in modern history. Investors who thought stocks were a safe bet will be scrambling for an exit. And when that moment arrives, only one place will be left to run: precious metals. This is why gold and silver historically surge after stock market crashes. When trust in paper assets disappears, the flight to real money begins. Durrett is warning that we are on the edge of this collapse, and the signs are everywhere. But if you think gold and silver are just safe haven plays, think again. Because once the dust settles, these metals won't just protect wealth, they'll create it. And that's where silver's real potential begins.
Because when you go into recession, basically all you can do is go up. You can't go down. But Trump doesn't have that. So what he needs to do is he needs to kind of rug pull the economy and create a quick recession so that he can then fix the problem. It's much easier to fix a problem than try to keep a problem from breaking. And what Trump's really doing right now, he's trying to prevent a recession. That's much harder than fixing a recession. As far as I'm concerned, it's impossible. So, but he's been handing such a bad hand that if he does create a recession, it might just blow everything up. That's why everybody wanted a soft landing, because they knew they couldn't really prevent one. You know, the so-called no landing crowd, the no landing crowd, everybody was kind of laughing at them, right? But so far it has been a no landing. A soft landing is kind of what we're having right now, where you kind of like, you almost hit a recession, you kind of get into the negative growth, you get really bad stuff, but you don't go into recession and then you start up again. That's what we're trying to do here. We're trying to create a soft landing. We're still in it. They asked Powell the last time that he spoke before Congress if we had achieved a soft landing. And he didn't even hesitate. He just flat out said no. He didn't even equivocate and say maybe. He didn't say, he said flat out, no, we haven't. Because he knows that we haven't started on an upward trajectory. A soft landing is you've landed the plane and now you're good, right? Now you're going back up. But that's not what we're seeing here. We're not seeing We haven't started back up yet. You can only talk about a soft landing in the rearview mirror. You've landed the plane and now it's done, it's over with, and now that's all the bad stuff's gone, and now we're looking at good stuff. Everything's going great. But the problem is, our budget is so out of whack, and we still have inflation, and we still have high interest rates. All that bad stuff has to get cleared out before you can even talk about soft landing. So we have a mess here. As a matter of fact, it's much worse than people realize. Much, much worse. And a lot of people have talked about this. Jeremy Grantham said this is the most dangerous. I don't think he used the word dangerous. He said vulnerable. He said it's the most vulnerable market he's ever seen or we've ever had. And what he's implying there is that what he means by the worst vulnerable is that when it finally does break, so much stuff is going to go bad that we're going to have to deal with a giant mess here. Much worse than any recession that we've had since the 30s. Much worse than that. And somebody sent me an email today and he was lining up all of these bad things are going to happen. I said, be afraid, be very afraid. Because when this stuff starts to break, I actually don't think that we're going to recover.
Silver has always been gold's shadow until the moment it isn't. Don Durrett has been watching this pattern for years, and he knows exactly what happens when the financial system breaks. Gold moves first, and then silver follows with a vengeance. Right now, gold is already signaling the start of something big. Central banks are hoarding it at record levels, investors are quietly shifting out of paper assets, and geopolitical instability is driving demand higher. But silver? Silver is still lagging behind, just like it always does before a historic breakout. Look at history. In the 1970s, gold soared during the inflation crisis, but silver didn't just follow. It exploded from under $2 to nearly $50, a 400% gain. In 2011, gold surged past $1,900, and silver rocketed from $9 to almost $50 again, delivering over 400% returns in just a few years. The pattern is clear. When gold runs, silver doesn't just catch up, it overcompensates in spectacular fashion. Why? Because silver is an extremely small market compared to gold, and when investors pile in, there simply isn't enough supply to absorb the demand. That's why Durrett sees silver's current price as a massive opportunity. It's sitting at a fraction of its all-time highs, artificially suppressed by years of price manipulation. But once confidence in the system shatters and the silver market wakes up, the rally will be violent, fast, and completely unforgiving to those who waited too long. And this time, silver isn't just riding gold's coattails. There's another force at play, one that's creating an unstoppable wave of demand unlike anything we've seen before.
And that's my point. So if you're expecting 2,500 gold or $2,400 gold, you're kind of betting against what we've seen over the last year. You're basically betting on. The thing is that in my opinion, gold's nemesis is strong economics, is the strength in the economy. If you look at 2012, 2013, when gold crashed, it was because the economy was basically coming back to life out of that 2008-9 recession. And 2012 is when everybody kind of said, okay, we're in the clear here, and gold crashed. We were at 400 HUI in 2013. And we bounced it, we hit it 3 times, and the third time it crashed through 400, and we haven't been back since. So 2013 is when we went under 400, and we crashed under 350 as well. We went under 400 was support, crashed through 400, and then we went to 350, and then 350 turned out to be kind of the high of the channel. So we basically went down under 350 in 2013. Here we are 11 years plus later, we haven't gotten above that. We did trade at 354, but I'm using a round number at 350. So we're still in that channel. And so I think what you just said is correct, that this gold buying, it's real. It's not going to go away. And what's driving that buying is still in effect. And what caused gold to crash back in 2012, 13, 14 was was economic strength. And we've been in economic growth ever since then. And so the only way that I think that gold would crash is if somehow, and I just don't see it on the horizon, I've never been this bullish actually, is that somehow Trump gets the inflation genie back in the bottle. So you go back down to 2% unemployment, and then you get jobs, and then somehow the job market improves and you pick up in economics and everything just starts working again. In other words, kind of a Trump miracle scenario kind of thing. If that happened, gold would crash. But I don't see that on the horizon at all. I see Trump juggling way too many balls in the air here, trying to, uh, basically get those balls off the table where he doesn't have to juggle them. I don't see that happening here. I, every to me, it just seems like it's going to get worse and worse and worse. Somebody said, and I think this made a lot of sense, that I ideally what Trump really wanted was what kind of rate what Reagan inherited. Reagan came into office when in a recession, and so Reagan could fix that problem.
Silver isn't just a monetary metal, it's an industrial powerhouse, and demand is accelerating at a speed the market simply isn't prepared for. The world is going green, and silver is the key element fueling that transformation. From solar panels to electric vehicles to 5G technology, silver is embedded in the backbone of the modern economy. Let's talk numbers. The solar industry alone is consuming silver at record levels, with over 140 million ounces used annually. Governments around the world are pouring billions into clean energy, mandating net zero emissions, and supercharging solar panel production. And here's the kicker. Unlike other metals, silver has no viable substitute in high-efficiency photovoltaic cells. As solar energy demand surges, silver demand will skyrocket with it. And it's not just solar. The electric vehicle revolution is ramping up, with each EV requiring up to 50 grams of silver for its electrical components. With global automakers shifting away from gas-powered cars, the demand for silver in batteries, charging stations, and onboard electronics is set to explode. Then there's 5G. Every high-speed network requires silver-coated components for optimal conductivity. As the world moves toward ultra-fast communication, silver consumption will only increase. Here's the problem. While demand is rising, supply is shrinking. Mining production has struggled to keep up, and silver deficits have persisted for 4 straight years. The market is sleepwalking into a supply crunch, and most investors have no idea. Durrett sees the writing on the wall. The industrial boom is setting the stage for a historic supply squeeze, and when silver's monetary demand collides with its industrial demand, prices won't just rise, they'll explode. But the real pressure is coming from an even bigger force, one that could cause silver to break free from decades of manipulation and rewrite the financial system itself.
27, 28, somewhere in there, I think we could top out. I think gold's just going to rip higher, and then we're going to have some type of a reset around 27, 28. But the miners, even though gold's been in a bull market for quite a while now, the miners have not. The miners are still in their channel. They haven't broken out yet. If you look at the HUI, it's been in the same channel since 2013. We need to get above 350, and we got a ways to go here just to break out on the miners. The HUI is at 312. You got to go all the way to 350 just to start a bull market in the miners. Now, when I talk a market, I'm talking about an extended bull market that goes all the way to 1200 to 1500. A big, big, long, extended bull market. For that to begin, you got to get to 350. I think we're going to go down to 265 as my target on the HUI. We were at 330 recently, and a 20% correction takes you to 265. And that's where I think we're going to go. We're going to go right around 265. We could overshoot and go down to 240, but I don't think we're going to. I don't think we're going to see a 240 handle, or we might see a 250 handle, but 265 is my target, and I kind of explained why. I just think that gold's going to bounce at a certain point, and once it bounces, that's when it starts. That's when basically you can go back to 2002 and you can, I think, history always rhymes. You can go back there and you can see where gold, it had been in this massive correction, this massive, tight trading range, basically all the way since 1980. Tight trading range. And then right there at 2000, 2001, 2002, that's when it started. That's when that extended bull market started. That's when the HUI broke out. And I think that's how history is going to rhyme here is the HUI is going to break out. But before we get there, we have one more correction.
For decades, silver prices have been artificially suppressed by a complex web of paper contracts, derivatives, and short positions controlled by the world's largest financial institutions. Don Durrett has been tracking this manipulation for years, and he believes the system is on the verge of breaking. Here's how it works. Major banks and institutional traders have been flooding the market with paper silver, futures contracts that promise silver delivery but are never backed by real physical metal. This has kept prices artificially low, creating the illusion that supply is plentiful. But that illusion is starting to crack. Physical silver inventories are drying up. In 2024 alone, over 400 million ounces were pulled from vaults, depleting the reserves of COMEX and the London Bullion Market Association. And now, with demand surging from both investors and industries, the ability to keep prices artificially suppressed is slipping out of their control. The setup for a silver short squeeze is now in place. If a critical mass of investors demands physical delivery instead of settling in cash, the entire house of cards will collapse. Banks that have been shorting silver will be forced to buy back at skyrocketing prices, triggering an uncontrollable feedback loop. We've seen glimpses of this before. In 1980, the Hunt brothers attempted to corner the silver market, causing prices to surge nearly 900% in less than a year. More recently, in 2021, the silver squeeze movement briefly rattled the financial system as retail investors flooded into physical silver, causing premiums to spike. But those were just warnings. Durrett is warning that the next squeeze won't be a temporary event. It will be the moment when silver finally breaks free from manipulation and trades at its true value. And when that happens, the institutions suppressing silver today will be the ones fueling its explosive rise. But there's another group that sees this coming, and they're already making their move.
When the end of this bull market finally comes, it will sell. The stock market will go down for like 3 to 6 months in a row. It'll just have red candle, red candle, red candle, red candle. It'll just go down, 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 down. It won't happen in a week or 2 weeks or even a month. It will take months to find its bottom. And so what I think is going to happen is the first 2 to 4 weeks, maybe the first 2 to 8 weeks, somewhere in there, the markets are going down, down, down. Gold and the miners will be going down with them, but then you'll get a bounce in gold, and people will run to gold. Gold will get a bid, and when it does, that'll be everybody will see it. They're like, okay, gold's a place to hide. The miners are a place to hide. So I think the bounce will happen somewhere between 2,600 and 2,700 is my expectation. So if that's as low as gold's going, then people will kind of front run that and they won't sell their miners, like hold on to them, like Newmont's at, I don't know, 42, somewhere in there. I don't think it'll go much below 35. So you're looking at 35, 36, 37, it'll go down there. And that's as far as it's going, in my opinion. It's not going to go back to 30. And so these miners aren't going to crash. They'll correct down maybe 10 to 20%. And then gold will bounce. And when it bounces, that'll be the floor for gold and the miners. And then everybody's going to start getting excited because then gold will keep going up and the stocks will keep going down. And that's when that's when you know that a decoupling is taking place. That's what happened from 2001, 2 till 2012 is you had that decoupling where the stocks weren't doing so good, but the miners and gold were doing great. The HUI was outperforming the SUI significantly, and that's what's going to happen. And I call it an extended bull market in miners, not a 6-month or a 12-month run. I'm talking about 2 to 3 years, an extended, and it could be longer. I actually think that the bull market in gold started in 2019. If you go back and look at the breakout at 1400, we've been in a bull market in gold for 5-6 years, quite a while now. And I think that's could last about 10 years. So
While most investors remain distracted by stocks and bonds, the world's most powerful financial players are quietly making their move: central banks. Durrett has been sounding the alarm on this for years, and the data is undeniable. Central banks are hoarding gold at record levels, signaling that a global monetary shift is already underway. In 2023 and 2024 alone, central banks purchased over 1,000 tons of gold, one of the largest accumulations in modern history. Nations like China, Russia, and India are leading the charge, rapidly de-dollarizing their reserves and shifting into hard assets. But here's what most people are missing: gold is just the first step. When fiat currencies start losing credibility, gold moves first, but silver follows with explosive force. History has proven this time and time again. Governments and institutions protect themselves with gold or bullions. But when the public catches on and starts looking for their own safe haven, silver becomes the go-to metal for individual investors, private funds, and industrial users. And right now, the world is standing on the edge of a currency reset. The US dollar is losing its grip as the global reserve currency, inflation is eroding purchasing power, and the financial system is being pushed toward a new reality, one where gold and silver will play a central role. Durrett knows that central banks aren't just preparing for inflation, they're preparing for a crisis of trust. And when that trust collapses, the demand for silver will surge as individuals, corporations, and even smaller governments scramble to secure real, tangible wealth. But there's one final trigger that could send silver prices into overdrive, a moment that will force the entire world to wake up to the reality of the financial system's collapse. And it's coming faster than most people realize.
And I lived through the 90s, and I remember in the 90s, that's when the Republicans basically balanced the budget because they said that debt mattered. They basically, because of what Reagan put into play, and Bush Senior, they basically were doing these huge deficits that were at the time we never had deficits of that size. And Newt Gingrich came into this contract on America, and one of the things in the contract on America was to balance the budget. And they balanced it. 98, 99, it was a balanced budget. Well, and since then, we just said, forget about that. We don't care about balanced budgets anymore. And from 2001 on, it was like balanced budgets were no longer a thing. We had basically adopted what Japan did, and we just started printing money. Whenever we need it, print it. We need it, print it. That's exactly what Japan did. And then they threw this name on it, MMT, modern monetary theory. And modern monetary theory is basically this thesis that debt doesn't matter as long as you have a printing press. It's insanity economics. And when we adopted that thesis, which we did, 2000, I say Hank Paulson was the guy that did it when they basically said, and the reason why I kind of blame it on Paul, didn't blame it so much on Paulson, was that when Paulson said, I need $750 billion, nobody said we're going to pay it back. That's where the MMT came in. It was, okay, we're going to print it, and then we're going to pretend we didn't. That's when spend and pretend began. That's when basically debt expansion. We just let debt expand. It was like, okay, we're going to print it, and then we're going to pretend that we did, and we're just going to keep borrowing more and more and more and more. Instead of saying, okay, we're going to borrow, we're going to give Hank, we're going to give you the 750 billion, but we're going to pay it back over 5 years. No, nobody said that. That was it. And so we just kept. That's when we adopted MMT, when we basically didn't put in a contingency that we're going to pay the debt back. Once we just said when we don't have to pay it back, then the next guy came along, and it wasn't very much longer after that. If you remember right, after we did the 750, we came in and we did another one right after it. And I think it was like, I don't know if it was TARP or if Hank Paulson's was TARP, but came in about a little bit after that, and they came in with like 400 billion. So it was like 700 billion. Oh, that worked. Now give me this, right? And it started the whole mentality of, if you need it, print it. If you need it, print it. I call it print and pretend. Print and pretend that, that you have to pay it back, or print and pretend that it's really debt. But it is really debt.
The moment of chaos is coming, and when it arrives, there will be no time to react. Don Durrett warns that once the financial system cracks, it will set off a chain reaction of panic, liquidation, and flight to safety, and silver will be at the center of it all. We've seen how this plays out before. When markets collapse, fear takes over, and investors rush to protect their wealth. But this time, the crisis will be unlike anything in modern history. Governments are trapped in debt, central banks are out of ammunition, and fiat currencies are losing credibility. When stocks, bonds, and even real estate fail to provide stability, there will be nowhere left to turn except precious metals. The warning signs are flashing red: bank failures, skyrocketing government deficits, and the quiet accumulation of gold by central banks all point to one thing: the current system cannot survive. And when the inevitable collapse hits, the demand for physical silver will explode overnight. Here's what makes this time different. Silver is already in a structural supply deficit, and industrial demand is eating away at available inventories. That means when the flood of new investors arrives, piling into silver just as they did with gold in the 1970s and 2011, there won't be enough supply to meet demand. Prices won't just rise. They'll break free from the manipulation that has held them back for decades. Durrett warns that once the dominoes start falling, silver could move at a speed that catches the entire financial world off guard. The only question is, will you be positioned before the storm hits, or will you be scrambling to get in once it's already too late?
People of global finance because of collateral. Those are what's been used for collateral. So what happens if suddenly those bonds are no longer considered risk-free? It changes everything. And I think that's going to happen. Now, I think it's going to start happening at the long end. The 10, 20, and 30-year bonds, the rates are going to start going up as they're no longer considered risk-free. And then it's going to go to the 5-year, and then it's going to go to the 2-year. And eventually it's going to get to the 3-month where it's no longer considered risk-free, if you believe that. But I think that is a world we're heading in. And that's a world that nobody really has considered the ramifications of. Because once those bonds are no longer considered risk-free, we're talking about basically turning U.S. debt into junk bonds, where the rates have to go higher. And the U.S., that's when the default kicks into gear. That's when you start seeing 10 years above 5%. And once you get the 10 and the 20 and the 30 above 5%, it's kind of game over for the U.S. That's when you're looking at default. Because then all they can do is borrow at the short end. They can no longer borrow at the 10-year. They can't afford 5% interest rates. So they can no longer borrow. That's the reason why the new Treasury Secretary is focused on getting the 10-year down. He wants to borrow money at the longer rates. But it's a big issue here. Everybody seems to think that the world as we know it is going to keep continuing on. They're going to kick the can. Trump's going to fix everything. Everything's good. And I'm telling you, it's a lot more shaky ground than people really realize. I think I'm not talking my book with the gold and silver. I really think that the U.S. economy is a lot shakier than perceived. Just do your due diligence and do more research on kind of all these things I've talked about.
When the dust settles from the initial shock, silver won't just be rising, it will be erupting. Don Durrett has seen this setup before, and he knows exactly what happens when confidence in the system collapses. Silver goes parabolic. In past crises, silver has delivered some of the most explosive price moves in financial history. During the inflation chaos of the late 1970s, silver surged nearly 2,400% from under $2 to almost $50. In 2011, silver soared over 400%, running from $9 to nearly $50 again. Each time it started slow, then went vertical as panic set in. The same setup is forming right now: the debt crisis, central bank desperation, stock market illusions, and industrial demand squeeze have all converged into a perfect storm. And this time, the stakes are even higher. Unlike past silver bull runs, today's silver market is already in deficit, and central banks are openly preparing for a monetary reset. That means the next silver breakout could be bigger and faster than anything we've ever seen. The real question isn't if silver will break out, it's how high will it go? Could it hit $50 again? What about $100, $200, or even higher? Some experts believe we're looking at a complete repricing of silver, one that could send it far beyond anything the mainstream media is prepared to admit. But once silver crosses a critical threshold, once it breaks out of its artificial suppression, it will be too late to buy at today's prices. That's why Durrett is sounding the alarm now. The window of opportunity is closing. And when silver moves, history tells us it moves fast. The biggest financial shift of our generation is already underway. Will you be ahead of it or left behind?
I still own it. You leased it. It's like a car, right? I lease you the car, but I still own it. You make payments on it, and I can come take ownership of the car anytime I want, kind of thing. But you can't rehypothecate a car because someone drives it. But if the gold is just sitting there in the vault, they can rehypothecate it. So there's this belief that they've leased out more than they own, and so that starts to create problems whenever you start to get shortages, which is what we're seeing in London. So once you see London shortages, then the rehypothecation starts showing its face, and then people say, "Okay, I want more physical. Give me my physical because I think you're going to run out." In other words, people that are in New York that have their gold in London, they're like, "Bring it home because I know you're hypothecating it, and I'm not going to get my gold." And we have this meme about people, doing the musical chair dance. Who's going to get their physical gold? Do I have a chair? Do I have my contract? So there's that going on. Plus, in the background behind all of this, you have in theory, I think the theory actually holds a lot of water, that there's a lot more paper gold than physical gold, unallocated gold, where people are holding paper certificates, and in theory, those paper certificates are worth not worth anything if there's a run on gold. So you got that going on. But in the background, you also have central banks who are acquiring gold because of Basel III. And Basel III is a huge, huge thing because for the first time, gold is becoming a tier one asset starting next year in 26. In 26, the European banks are all going to adopt Basel III. So they can start collecting gold now. They can front run Basel III. But if you have gold on your balance sheet as a tier one asset, you can borrow against it on a fraction of it. But currently, you can't do that. So gold on your balance sheet now becomes very valuable. So more and more, this isn't central banks, these are actual real banks. So you're going to actually have real banks putting gold on their balance sheets. But central banks are doing it as well because the central banks want to have gold they can give to their banks. But gold is actually becoming a legitimate asset. It's tier one. And the US is supposed to adopt it in 27 or 28. The US keeps pushing back. We don't want this. We don't want this. But if the European banks do it, US banks are probably going to do it too, and probably in 27. But if they don't do it in 27, they will start to front run it if it happens in 28. But it looks like it's going to be Europe 26, US 27, 28. And so those banks are going to start putting gold on their balance sheets. Well, there's probably not enough gold to go around. And so gold is going to keep going up, up, up. So Basel III is a massive, massive precursor to higher gold prices. So you have so many factors. And another factor that I think might even be bigger than Basel III, if you can imagine that, is the fact that US bonds and US debt is considered risk-free. Well, and those bonds have been the state.
The silver explosion won't happen in isolation. It will be fueled by a global wave of panic, wealth destruction, and desperate flight to real assets. Don Durrett sees it coming, and the pieces are already falling into place. As the debt crisis spirals out of control, governments will be forced to devalue their currencies just to stay afloat. That means one thing: a rapid loss of purchasing power for anyone holding cash. We've seen this play out in countless economies before: Venezuela, Argentina, Zimbabwe. where fiat money became worthless while hard assets soared in value. Now, the same forces are creeping into major economies like the US, Europe, and Japan. At the same time, institutional money will flood into gold and silver, just as it always does during crises. Pension funds, hedge funds, and sovereign wealth funds that previously ignored precious metals will suddenly have no choice but to allocate billions. But here's the kicker. There isn't enough physical silver to go around. The silver market is tiny compared to other asset classes. If even a small fraction of the trillions sitting in stocks and bonds shifts into silver, the supply-demand balance will snap, and prices will move higher at a speed no one is prepared for. This isn't speculation. It's simple math. Durrett knows that the next financial panic will force silver to break free from decades of suppression. We aren't just talking about a price rally, we're talking about a once-in-a-lifetime repricing event. And when that happens, those who are already positioned will witness one of the most violent wealth transfers in modern history. The question is no longer whether silver will move, it's who will be ready when it does.
I don't think it's the whole story, and I actually don't think we really understand it because the numbers are really high. The numbers are higher than anything that can really explain. Things have gotten pretty wonky on both the gold and silver, but the amount of gold that's been moving from London to the U.S., I think that the front running the tariffs and the arbitrage, both of those, I don't think they really explain what's happening. I mean, it's possible that those are the two things. Another one that I've thought of is that the tariffs started the movement. In other words, so the exchange decided, okay, if there's going to be tariffs, we better expand our inventory because we don't want to have to go and buy gold from London at a 25%. If Trump throws on these 25% or 10%, we don't want to have to go buy it from London at that. We have to front run that. And I think that maybe started it. And then once it started, the arbitrage, that created arbitrage because they started moving more gold over. And then they found out that there wasn't enough gold in London or enough of the bars that they needed. And so they had to put a delay on 4 to 8 weeks. Now, some people are saying the reason for the delay because they were the wrong bar types. They had to send them to Switzerland first to get them converted, and it took 4 to 8 weeks. But if you own the gold, I don't know why you can't own it before it gets shipped to Switzerland. Maybe you can't take ownership. Maybe they have to convert it first before they can give you ownership. I mean, that's a possibility. And so you have this 4 to 8 week transfer of ownership. So there's that. There's a lot of unknowns here on exactly what's going on here, but it hasn't really stopped. Some people say that 48 week will all get resolved. It's just a matter of a couple months and everything will be back to the 1 to the 2 days. The one thing here that there's a lot of factors at play, which have always been there. One of them is this whole idea of paper gold that's been rehypothecated, where you actually have physical gold rehypothecated through leasing. So they basically what they do is they can lease out the gold multiple times to multiple people, and the physical gold stays there. And people own it. They own it through the leasing. They're like, okay, I'll let you here. You can lease out the gold. You can take ownership of it, but the gold doesn't move.
The moment silver truly breaks out will be unlike anything we've seen before. Durrett isn't just predicting a price surge, he's warning of a structural reset in how silver is valued, traded, and perceived in the financial world. Right now, silver is still treated like a second-tier asset, a volatile afterthought to gold. But when the debt crisis forces governments to abandon fiat stability, when central banks lose control of inflation, and when institutional investors are caught off guard by silver's scarcity, the market will be forced to wake up to reality. This isn't just about individual investors scrambling for protection. Entire industries depend on silver, and when prices start running, manufacturers won't hesitate to secure their supply at any cost. We're talking about tech giants, solar companies, automakers, all needing silver for production and suddenly competing with investors for an asset in extreme shortage. And that's the breaking point. Once supply chains are disrupted, Once silver refiners can't keep up with demand, once governments start prioritizing reserves for national security, silver's price won't just rise. It will be forced to find a new equilibrium at levels unimaginable today. Durrett has seen this setup before, but never on a scale this large. The last time silver exploded to $50, it was driven by investor demand alone. This time, it's monetary panic, industrial necessity, and supply destruction colliding all at once. The old system is crumbling, and silver's long overdue revaluation is approaching fast. But by the time mainstream investors realize what's happening, it will already be too late to buy at anything close to today's prices. The silver repricing event is coming. Are you prepared? Silver's moment isn't coming, it's already on its way. And Don Durrett's warning couldn't be clearer. We are standing at the edge of the greatest financial shift of our time, where the collapse of debt-fueled markets, the failure of fiat currencies, and the scramble for real assets will trigger a once-in-a-generation repricing of silver. We've seen the warning signs: runaway debt, central bank desperation, market manipulation breaking apart, and industrial demand surging past supply. Every major crisis in modern history has followed the same pattern. Gold moves first, follows with force. But this time, the conditions are even more extreme, the leverage is even greater, and the potential upside for silver is unlike anything we've seen before. The question isn't whether silver will break free, it's who will be ready when it does. Because when it finally explodes past $50, past $100, maybe even beyond, those who ignored the warning signs will be left watching from the sidelines. Those who position themselves early will witness one of the most violent wealth transfers in modern history. The time to act is now, before silver reclaims its true value, and before the chaos in financial markets forces the world to wake up to reality. The biggest silver bull run of our lifetimes is already taking shape. Are you in, or will you be left behind? And remember, this is not financial advice. Always do your own research and consult a professional before making investment decisions.